Thank you so much for joining me in another video. I've reached 1,000 subs, guys. I would love it if you could watch until the end of the video so that I can close in on that view time. So the fun and games in the market continues. So as we close out August, there is a general myth that August is the quietest month of the year when it comes to the markets. But is it really? With the US hitting the beach and Europe going for our customary 4-week vacation, there are fewer events in the corporate world and markets take a snooze when it comes to activity. However, as with most things in the markets, and also given the excellent year we're having with closed beaches and our growing love for our sofas, August has been an interesting month for the markets. So the US elections have also in the past created volatility and optimism in the markets. So I think there is a little more ramp up for that as we should start seeing the impact of elections as we move towards Q4. Wait, hold on, I shouldn't really say that because Q4 is now, right? So there you go. So back on it, August has been a good month for market investors. So the S&P finished about 8% up on the month. I'll try and put a graph down there somewhere so you can visualize what I'm talking about. And notably, the US market is now higher than we were in February 2020, which wipes out all of the pandemic losses and puts the US up at 5% year to date. Can you believe it? Before we get into it, this highlights a couple of points that I wanted to make. Time in the market, recoveries take place, and also being a consistent investor pays, finally. And this point is well illustrated in the next part of the video where I'm talking about market returns. So taking market returns is okay because there is more behind the market which meets the eye. Well, in the YouTube community, I've noticed that we have a pretty good idea given our affinity with all things tech. So we know all things tech are reaching new peaks. That's pretty clear. There's flying winners, but there are many other sectors which are at the brink of bankruptcy actually and well below the water. Forget U and V recovery, people. It's all about the K-shaped recovery. So what is the K-shaped recovery there? The economy returns to normal, but not all sectors bounce back in line, okay? This creates a little bit of a splinter. So with some sectors soaring really high and others remaining pretty stagnant or returning slower than anticipated, creating a little bit of rift between the guys that have and the guys that have not. A great example of this is the US, and it's pretty clear from the US that tech is surging. It's actually flying. The collective valuation, guys, of just 5 companies, which are Microsoft, Apple, Amazon, Alphabet, which are Google, and Facebook, now eclipse, guys, hold your seats right here, Japan's entire topics, and that is the Tokyo stock price index. Then the average S&P 500 stock is about 28.4% below the pre-pandemic peaks. So let me say that again, the S&P 500 is up 5% year to date, and that is attributed to the stellar performance of the US tech market, whilst the average return of the S&P stock is down 28.4%. So what we see from that is if you're not tech, then you're not booming. There is a huge gaping chasm between the haves and the have-nots. I thought there was someone at the door, but there wasn't. This room is really beginning to creep me out these days. So there is a gaping chasm, like I was saying, between the haves and the haves not. And these have created not only political, regulatory and tax headwinds, with the 5 giants having to appear before Congress last month. I'll link my video down to the fangs below so you can see what was said. Guys, it is important to note that 1, this is just where the world is moving. We have been shifting to a more digital world for over about 2 decades, and the virus has given us a notable push, but the trend was always there and apparent. And the second thing is, valuations are still nowhere near the crazy peaks that we saw of the 2000 dot-com bubble. There are lots of distortions which make it really hard to value stock, and these notably are the quarter-to-quarter savings caused by lockdowns and also the money pumped in by governments. Actually, let's just talk about that money pumping for a second, right? Through my research, I found that there's an utter disconnect between the markets and the economics of it all. There's mass unemployment, huge commercial vacancies, insane structural changes to how we generate economic value as societies, but yet globally stocks are back up really strong strongly from the February and March lows, which are the culprit, right? There's been mass money printing, so major central banks have so far created 5 billion in currency, which would result in asset price inflation. With most statements like this, economists tend to disagree that rational buyers of stocks look at fundamentals and buy according to value. So Q board Robin Hood traders are spending stimulus checks on buying hurt stock. Sorry, just had to put that one in there. However, I am finding it hard to disagree that there is still overall strong optimism in the markets. And so let's just hold our horses and let's talk about Europe for a second. So Europe, on the other hand, is a little bit of a different story. So there have been pretty much a lot of positive bullets to note. So for example, the German business confidence on the rise and ripples of strong performance. Overall, it's not that rosy. So even though the S&P was up 5% for the year, the Europe index stocks 600 is down 11%. And why is that, guys? Well, basically, the UK has no tech, so we're out. And the Europe doesn't really have that much either. So again, per the discussion around the long-term trends in the world moving towards tech, there's a fundamental long-term trend of Europe underperforming versus the US. So the MSCI Europe, a European equities index, which tracks the return of stocks within 15 European developed markets, for instance, has delivered about 94.5% over the last 10 years. Okay, that sounds okay. But the US has delivered something like, what was it, 311%. So Europe has struggled after the financial crisis. In addition to that, the budget and government rules that ensued just about choked off any growth that was even going to happen. But there are some banks out there, like Goldman Sachs no less, who feel that Europe is now poised for stronger growth. There are large stimulus plans on the horizon to the tune of something like $900 billion. And there's also fiscal solidarity across the region to support a recovery. There's a little bit of an interesting right turn here though. So that's the diversification argument. And I'm looking at US and China. There is a concentration of a handful of tech companies bringing the bulk of the US returns, but there are interesting long-term growth and steady stable stocks in energy and finance. So having that exposure to Europe would seem pretty reasonable to diversify out some of that volatility and dependence on the US giants, right? So what do you guys think? What is the stock market saying for you? Let me know down there in the comments below, and thank you so much for watching the video if you did hang on to the end. Like, comment, subscribe down there. Let me know what your thoughts are. But until next time, cheers guys, bye.